Welcome back to All Things Money. I'm David Blain, and during today's show, we're talking a little bit about why we think the global bull market will continue, or at least will not turn into a global bear market. We've looked for some choppiness ahead. Certainly not going to be a smooth ride, a lot of ups and downs, but we don't expect a double dip in the recession. As always, if you happen to miss the first part of the segment, we post the audio within a couple days on our website, which is www.dlblain.com. That's DLBLAIN.com. Or give us a call at 633-0107, and we can get you a copy if you missed the show. So we were talking about how of the 39 commodity models we follow, 62% are still on buy signals. Currently, commodities are correlating very positively with equities, another sign that the markets and economies around the world are recovering. Consumer prices, of the 66 consumer price indices that we look at, 95% have positive momentum, meaning that the price indices are going up. Inflation, which we don't want high inflation, but the biggest danger right now is a double-dip recession or even deflation. And so with 95% of the countries around the world prices going up, we think the reality for a severe deflationary period is very low at this point. And by the way, in case you were wondering, Japan, Ireland, and Qatar are the three countries that have negative price appreciation. We track 24 different economies, their business confidence index. All 24 are maintaining positive year-over-year momentum, and of the 63% are positive, not just year-over-year, but in general. We look at things like the purchasing manager indices. Purchasing manager indice is a good indication of the wholesale market. When we look at consumer prices, that's at the retail level. The purchasing managers index, we look at those purchasing managers at big companies that purchase wholesale and things like that. We see that 81% are maintaining positive year-over-year momentum. Industrial production, of the 53 industrial production indices, we see that of the 53 indices, we see 92% are maintaining positive year-over-year momentum. And of the OECD countries, 97% have positive year-over-year momentum. And the one negative one is, you probably guessed it, is Greece. Greece is the only one that doesn't have positive economic indicators going forward. Now, one of the things that, as I mentioned, when we're talking about all these statistics, we're talking globally, and these are all global statistics. The majority of the global statistics are positive. That does not mean that all countries are benefiting equally. I've mentioned many times on this program in previous episodes that around the world, if we look at the different countries, there are certain countries experiencing what we would call secular bull markets and others secular bear markets. And what do we mean by this? A secular market is a multi-year period of time where prices are either going up or down in the stock market. We have highlighted 17 countries around the world that we feel are in what we would call secular bull markets. For example, Singapore, Taiwan, China, Brazil, India, South Korea, Hong Kong, Russia, Mexico, Australia, and Canada are in what we would call secular bull markets, meaning, and each one had a different starting point, but many of them, since the late 1990s or early 2000s, their stock markets have been appreciating significantly. There are also several countries in secular bear markets. That would be Germany, the United States, Japan, France, the United Kingdom, and Italy. And when we look at these markets, once again, their start dates all vary, but somewhere around 2000, the early 2000s, these countries entered into a multi-year period of decline in their stock markets. And so when we look at the global markets, what we see is these countries that are in secular bull markets are actually pulling the other countries along. So as you're looking at investing globally, I'd encourage you to take a look at some of the countries that are experiencing the secular bull markets as opposed to the secular bear markets. Typically, the average U.S. investor has a U.S.-centric portfolio, meaning that they have the majority of their money invested in the United States. This is what they're comfortable with. This is what they drive down the street and they see Lowe's and they see McDonald's and they see, companies they're familiar with, and so they invest in them. And there's certainly something to be said for that, but with the economy in the world the way it is today, the U.S. makes up somewhere around 45% of the world's stock market. And so there are numerous opportunities around the world, and there are numerous countries around the world that are not experiencing the same problems that we are. In fact, what I'm going to do now is I'm going to talk about some of these countries that are in these secular bull markets. Once again, countries like Singapore, Taiwan, India, Brazil, South Korea, Hong Kong, Russia, Mexico, Australia, Canada. We're going to look at some of the factors that are going on in their countries, such as GDP growth, unemployment, consumer confidence, housing, and we're going to show what a difference it makes between those countries and countries in the secular bear markets, such as the U.S., Germany, France, Italy, Japan, and but we'll take a look at that when we come back. So for All Things Money, this is David Blain. We're going to take a quick break.